Hi everyone, Donna here with Bookkeeping Made Simple, and I want to talk today about the different tax obligations that are incurred by small businesses. And I'm not going to go into how to file them, but I am going to go into what you should expect. So this will be kind of limited. It may be kind of a short video. With that said, as always, if you enjoy these videos, please like, share, and subscribe. If you have any thoughts or would like me to cover a certain subject, feel free to comment in the comment section, and I'd be happy to, if I'm able to, I'll be happy to do a video on that. And of course, this is available on YouTube and Spotify. So with that said, let's just dive right in. Small business owners, once you start your business, you're going to start creating tax obligations. And I want to start off by talking about simply how different business entities are taxed, and how those taxes are reported, and then kind of move on from there. So the easiest business model to start is the sole proprietorship. This is also how a sole member LLC is treated for tax purposes. So if you have a single member LLC or a sole proprietorship, for tax purposes, they are one and the same. They're a little bit different. I'll go over that in a different video. But for tax purposes, a sole owner LLC is a sole proprietorship. Those are reported on your 1040 on Schedule C. So we will report your income, take out your expenses, and account for your assets and liabilities. And that's all on your personal tax return on Schedule C. A multi-member LLC or a partnership is also a flow-through entity. And by flow-through, I mean the income from those are reported on the partner's tax returns, and the partners pay tax based on their proportionate share of the income. Partnerships or multi-member LLCs need to report their taxes or their income and expenses on Form 1065. And that we will put in all of the information for the business as a whole, as well as what percentage of shares of stock, what percentage of ownership each partner has. And then those generate a Form K1 that each partner then takes for themselves, that reports their proportionate share of business income or loss, which they then need to report on their own 1040 individual tax return. If you are a S Corp, and you can be an S Corp after having established your business as a single owner LLC or a multi-member LLC or a partnership or a sole proprietor, you can ask to be treated as an S Corp for tax purposes. S Corps also generate a K1. They are also a flow-through entity. So the members are the stockholders of an S Corp. And there's a lot of limitations to that. Also, the S Corp files a Form 1120S and reports that all of the business gains are income or loss. Also on a Form K1, depending on the proportionate amount that each shareholder is responsible for. And by proportionate, I mean if you have a partnership or an S Corp where one person owns 60% and another one owns 10% and another one owns 20% and two more own 5%, they're only going to be responsible for the percentage of ownership that they have. So we have to figure out the total income or loss and how much to assign to each partner. So, and that goes for S Corps as well. And then we have C Corps. C Corps are the most complicated entity. For tax reporting purposes, C Corps pay their own tax. All the others are called flow-through. So the partners or the owner reports the tax or reports the income and pays tax on their individual returns. In a C Corp, the corporation has its own return and it pays its own taxes. And then the shareholders, if they received a distribution, will then, or a dividend, will then pay taxes based on what they took out of the business or the dividends that were paid to them, depending. Like I said, it's quite complicated and there's a lot that goes into it that is not relevant to this video. So we have different business entities, all with different tax obligations. Like I said, the C Corp being the most complicated. The C Corp is taxed currently at 34% of net income. Now, there are ways around that. People ask me all the time about quarterly taxes. There are two types. One is if you have payroll. Payroll is its own pain in the neck. So payroll does have quarterly taxes attached to it. When you have payroll, you need to make your federal payroll tax deposits through EFTPS. And if you're wondering, that stands for Electronic Federal Tax Payment System.org. No, not .org, .gov. EFTPS.gov. And that you log in with your EIN and your PIN and a password, and you can make all of your tax deposits right there. When you pay taxes before the tax deadline, we call them tax deposits. That means basically you're putting money in your tax account at the IRS. At the end of the year, regardless of the kind of entity, we need to know how much you did pay and how much was payroll tax. Payroll tax, again, is its own creature. When you have payroll, you're going to be obligated to remit federal tax withholdings that is withheld from your employee's paycheck. You will have to take care of federal unemployment tax, state unemployment tax, and state withholdings, as well as what's called FICA, which is withholdings for Medicare and Social Security. So in accountant speak, we have to cover federal withholdings, FUTA, federal unemployment tax, FICA, and by the way, FICA, the Medicare and Social Security, the employee pays half, the employer pays half. Federal withholdings comes entirely out of the employee's paycheck. Unemployment, both for the state and the federal, is entirely paid by the employer. Employers sometimes forget about this because they're the ones that are actually making the payments, even though the amounts were withheld from their employee's paycheck. Along with those tax deposits, both for federal and state, there are also filing requirements, and those are generally quarterly. What most people are asking about when they ask me about quarterly taxes is quarterly tax deposits. So if your entity, or if you as an individual as a result of your entity, is going to end up owing more than, I think it's $1,500 at the end of the year, the IRS is going to require you to make quarterly tax deposits. They want you to prepay your taxes. So if you end up owing $20,000 at the end of 1 year, then they're going to say, look, you need to pay $5,000 a quarter, and these are due on the first day of the quarter. Or the first day of the following quarter. So for quarter one, your federal tax deposit is due on April 1st. This is not the same as quarterly taxes, although that's usually how people phrase it. It's confusing because you are paying taxes, but you're paying ahead. So that's, there's no filing requirements with tax deposits. You're just making your payments ahead of time. You can make those payments either through the EFTPS system if you're signed up for it. So if you have employees, you will be signed up for EFTPS. Or if you are a sole proprietor, single owner, anything but a C Corp, you can pay them through the IRS website and tie it to your Social Security number. There's no filing requirement there. You just go in and make a payment, put your Social Security number in, and they will attach it to you. If you make quarterly federal tax deposits, you also need to make sure that your tax preparer has that information at hand, because we need to report to the IRS that this person, we've done their taxes. Last year they owed $20,000. They've made $15,000 in tax deposits. So really all they owe at the end of the year now is this much, for example. So we really need to know that, just like we need to know about the child tax credit. We need to know if you are filing for a year that was 2020, 21, 22, we need to know if you received any stimulus payments, if you got an advanced child tax credit, any money that you've gotten from the government or paid to the government in advance, your tax preparer needs to know about it. So we have payroll, we have quarterly tax deposits, and we have sales tax. Sales tax is a little tricky because that is very different state by state. Actually, so is payroll tax. Some of the things about payroll tax. By the way, if you are a remote worker, if you have been working from home since the pandemic, you may want to be aware that in some states, and New York comes to mind, if you are wondering why your employer doesn't want you to work remotely anywhere but your home state, it is because some states, particularly New York, have rules that if you're in their state so much as a day, you have to pay payroll tax to that state. So the employer is not going to want to set up a New York state tax account if they don't have a presence in New York state, if they don't have to. That is meant to cover athletes, musicians, people who do big ticket items, but they can and have used that against a single person who's just in New York on business, or in New York for a couple of days and work from there. That you really have to be careful about that. And so if you're wondering why your employer is saying, nope, you cannot just move up and move to these states, you can't work, you can't go on vacation there and work, it is because of these tax laws. It's not just random. And that pertains to payroll tax. It can also pertain to corporate tax. So there's a reason why, if you are a remote worker, that your company doesn't want you to work in certain states. And you should be very, very aware of that. So moving on. Sales tax. Sales tax is different for every state. Some states only tax the end user. I like those states. So if you are a car mechanic and you put parts into people's cars, the final customer should be the one paying the sales tax. So you will collect sales tax from your customer and remit that from the state. You need to keep in mind, this is not your money. I have had clients run into this where they brought this in, it's sitting in their account, so it was their money, and they ended up with such a large sales tax obligation that they couldn't pay because they spent the state's money. You have to be very aware that if you are obligated to collect sales tax, that is not your money. Let's just kind of go with that. So you collect sales tax from your end customer, and in states in which the end customer is the only one that's taxed, you do not have to pay sales tax for your supplies. Going back to the mechanics example, if you are a mechanic, you're collecting sales tax from your customers and you install brakes. You don't have to pay sales tax on your brakes that you bought to install in a customer's car, because the customer is the end user and they are responsible for the sales tax. There are exemption forms that you can fill out and provide to your suppliers so that they don't charge you sales tax. If you are a mechanic, you charge sales tax to your customers, you collect that on behalf of the state, and you buy a set of brakes to put on your own car. Now you have to pay sales tax on that because you're the end user. It gets really complicated when it goes across different state jurisdictions. I'm most familiar with Utah laws, which basically state that things that you purchase to attach to real estate, such as a roof, an air conditioning unit, light fixtures, anything like that, water softeners, are not subject to sales tax in Utah. I cannot speak for the other 49 states. Some states will tax them. If you're an e-commerce retailer, you will need to find some software that will allow you to keep track of sales tax for all of the tax locations in which you have customers. So let's say you live in a state that has no sales tax, like think of one off the top of my head. Who doesn't have state sales tax? Oregon, Washington. I think it's Oregon, because Washington has no state income tax, but they have sales tax. Oregon has no state sales tax, but they have income tax, if I'm remembering correctly, and I could be wrong. So if you live in a state that happens to have no sales tax, but you sell to someone who lives in a state that does have sales tax, you're going to be responsible above a certain, there's a certain percentage that you kind of get away with it. But once you have a nexus in that area, in that state, and that means you have a business presence, a substantial business presence. So if you have employees in that state, if you have more than about $10,000 of sales in that state, if you have an office in that state, you will be required to remit the sales tax for that area. So even though I'm located in Utah, if I was an e-commerce retailer, even though I would have to pay sales tax, remit sales tax for my Utah sales that I should have charged my customers. Again, I keep saying pay sales tax. What I mean is remit. So you are collecting it. You're kind of the middleman. You collect it from your customer and you send it on to the state. The state is asking you to collect it from your customer and send it on to them. It's not your money throughout this whole process. But if I have $20,000 of sales in California, now I have to worry about California sales tax. And if that is within Los Angeles, I have to worry about California and Los Angeles County and Los Angeles City. So there's a lot that goes into this, but just be aware that if you sell goods, and in some places services, but not most places. In Utah, services are not taxed. Again, that's the state I'm most familiar with. The others I would have to double check. Most places that I know of will tax goods, but not services. So you need to be aware of that. If your state charges sales tax for what it is you are selling, you're responsible for collecting that from your customer and again, sending it on to the state. At no point in this process does it belong to you. And I would strongly recommend having a separate sales tax account so it doesn't commingle. So we have property tax would be the next one on the list. Texas has very high, it has no income tax, but they have high property tax. And so if you own a building or land in any of the 50 states, you will be on the hook for property tax. Whether you are an individual, you will have individual property tax that you have to pay as an individual. If your business owns the building, the business is required to pay it. Now, it's important to recognize, especially in terms of sales tax, a lot of this isn't really your money. And that's where I see a lot of people get into trouble. Payroll tax, the employer withholds it, and remits it, but isn't responsible for it coming out of their pocket. Although it seems like it, because when you pay your employees, even though the money's withheld from your check, it can kind of seem like you have to pay it all because you're the one seeing both sides of it. But it is withheld from your employee's check and then remitted to the state or the federal government. Now, the big question is, how do I get my tax burden as low as possible? When it comes to payroll, you're kind of stuck. You have to pay payroll tax. However, and same thing with sales tax. If you sell something that has sales tax attached to it, you collect it from your customer, you remit it to the government. However, for income tax specifically, all of the money that you spend in anticipation of earning money from it, because you have to spend money to make money, right? The money that you spend in anticipation of generating revenue is most likely tax deductible. In other words, you pay tax on your net of your revenue less your expenses. You also, and one of those expenses, by the way, is depreciation, which is a non-cash expense, but we can use that to help lower your tax burden. So what can you do to lower your tax burden, both as an individual and as a C Corp? One is reinvest as much as possible in your business. I hear people say all the time, Amazon didn't pay taxes because of deals that they made. And they did make a lot of deals to defer taxes. However, the reason Jeff Bezos didn't have to pay taxes for like 20 years is that he didn't take a paycheck. He reinvested everything Amazon made, he reinvested it into Amazon. So he was buying inventory. He was upgrading his websites. He was developing the delivery system. He was doing the things and putting the things in place that make it a behemoth today. So he wasn't actually making a profit. And this is where a lot of people really don't understand it. He wasn't making a profit. I mean, he had a profitable business, but he was taking those profits and shoveling them right back into the business. So if he had $10,000 worth of profit, he was using that to invest more into Amazon. Donald Trump, at one point, there was a big kerfluffle about he only had to pay a few dollars in income tax, but he had made huge tax deposits prior to that. So when they did his taxes and they started to figure out he owes this much less what he's already paid, all he had left to pay was a few dollars. He actually paid millions. And whether you're a supporter of him or not, or not a fan of him, I think those facts need to be out there. So he had prepaid millions of dollars in taxes. So when tax day came, he did not have an obligation to pay because he'd already paid it. He also was able to reinvest a lot of his money back into his business. And I don't know enough about the Trump family holdings to be able to speak beyond knowing what I know about his tax return. I have looked at his tax return, the ones that have been made public. So, those are the big things. So you can prepay your tax obligations. And if you are going to end up owing at the end of the year, the government would like you to prepay your tax obligations. You can mitigate your tax obligations, avoid as much as possible by being thoughtful and judicious in your spending, reinvesting your funds back into your business. And you can also do things like put money into tax deferred accounts, such as a 401k or an IRA, that is going to help you when it's time to retire. There's a number of strategies we can use to help you reduce your tax burden. But these are the tax obligations that you are going to be required to have as a business owner. They are complicated. There's a lot of them. I'm sorry, I didn't make the rules. But you do want to make 100% sure that you are in compliance all the way down the line. At the other side of the coin, what happens if the government said, if you don't pay, or if you don't file? Well, the government gets really testy. They don't like it. If you do not file payroll taxes, they are going to assume that you owe them. And you can file a return that shows no tax paid, no employees. It's called a zero due return. And you basically say, oh, well, right now I have no employees, therefore there's no payroll tax due. I didn't pay anybody anything, so I don't owe anything. You still have to make the filing, however. Same thing with sales tax. If you historically have had a sales tax account with the state, you still have to file a return when it's due, although the return can say, I had no taxable sales. So long as that's legitimate. But the filings are required. So if you want to stay in compliance, hopefully you do, you have to make your filings on time. And that's it. That's all I'm going to talk about today. And I will talk to you again real soon.